Hello and welcome to the second of the 4 webinars in Mayer Brown's Banking and Financial Services Litigation series for 2021. I am Ian McDonald, co-leader of the firm's Global Litigation and Disputes Resolution practice and a co-leader of the Banking and Finance Litigation practice. Joining us as speakers for today's webinar entitled Antitrust Evolution, Big Changes in Global Antitrust Law and its Potential Impact on Financial Institutions are antitrust partners from around the firm whose practices include merger control proceedings, cartel investigations, and antitrust litigation, amongst other things. Our speakers are Bill Stallings from our Washington, D.C. office, Francisco Todorov from our Brazilian offices, Nathalie Jalabert from our Paris office, Christian Horskotter from our Dusseldorf office, and lastly, David Harrison from our London office. Before we begin, we'd like to mention a few housekeeping matters. Please note, when accessing Mayer Brown webinars via our On24 platform, we suggest avoiding using desktop visualization software such as Citrix to decrease disruption or quality loss. Secondly, as listed under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. If you have any questions that are unanswered during the presentation, I invite you to submit them using the Q&A feature on the left side of your screen, and we will do our best to follow up with you directly after the webinar has ended. Regarding CLE credit, we will be providing an alphanumeric code during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign sheet that was emailed to you with login instructions for today's program. If you need CPD points, please send your request to our Learning and Development team at ld@mayerbrown.com. The forms are also available to download on the right-hand side of your screen under Resource List if you need them. With all of that said, let's get started. Over to you, Bill.
Thank you very much, Ian. I will be focusing on antitrust and fintech in the United States, specifically what to expect from the new Biden administration. This is actually a somewhat challenging topic in that the administration has yet to fill out its antitrust team. In antitrust, as in many legal areas, the saying, policy is personnel, is very true. The individuals leading the agencies matter. They are the ones setting enforcement priorities and bringing cases. But as of now, there are no nominees for the head of the antitrust division or the FTC chair, the two most important positions in U.S. antitrust enforcement. And to be clear, this is unprecedented delay. These positions are usually named well before inauguration, yet now we are more than 100 days into the administration itself. So why is this? Why have there been no nominations? I think it's at least partly due to an ideological divide. Around the time of inauguration, several centrist candidates were whispered as potential nominees, but they failed to garner support from progressives. In turn, progressive candidates seemed unable to drum up support from centrists. So as of now, we're left with no one while the administration hashes things out. Of course, in the meantime, the agencies will continue to operate. The antitrust division is led by career officials, and the FTC is working under acting chair Slaughter. They will continue to move forward, but without political leadership. And it's that political leadership that often is most necessary to drive hard cases. So although the top positions have not been filled, there have been some signals from the administration, most notably 2 appointments to lower level but very important positions. And both of these individuals are from the progressive wing of the Democratic Party. First, Lena Khan has been named to be one of 5 FTC commissioners. She will be filling a vacancy that was recently created. She's a professor who has displayed an aggressive focus on big tech. Her influential 2017 Yale Law Journal student note argued that the antitrust law should be interpreted more broadly with respect to digital platforms like Amazon. She's also recently said that the FTC needs to be, quote, much more vigilant about large acquisitions, especially in digital markets. If confirmed, she would be the youngest person to serve as an FTC commissioner. The administration also appointed Tim Wu to the National Economic Council, and his title is Special Assistant to the President for Technology and Competition Policy. Now, the National Economic Council is not a traditional antitrust role, and his title therefore raises questions about the role of the White House in an antitrust enforcement and competition policy setting. We'll just have to wait to see how that unfolds. But like Khan, Mr. Wu is an outspoken critic of Black's antitrust enforcement. His 2018 book, The Curse of Bigness, Antitrust in the New Gilded Age, is quite explicit. He warned that, quote, extreme economic concentration has caused gross inequality and material suffering. So I think we can expect from these appointments to see a very progressive agenda coming out of the new administration. And in addition to the administration's activities, there's also action in the U.S. Congress. Senator Klobuchar, the ranking Democrat on the Antitrust Subcommittee, has introduced an omnibus reform act that would, among other things, lessen the standard for the government to block a merger and also actually switch the burden of proof to merging parties under certain circumstances. And it's particularly intriguing to note that antitrust reform right now is attracting bipartisan attention, which is frankly a rarity in the current Washington climate. For example, Senator Josh Hawley, an outspoken Republican from Missouri, has introduced a bill aimed at big tech that would ban mergers and acquisition by companies with market capitalization of more than $100 billion. And obviously, with that type of metric, it could apply to financial services as well. And regardless of whether the eventual nominees are progressive, centrist, or somewhere in between, I think it's safe to say that we can expect continued aggressive antitrust enforcement regarding financial issues. There's been a significant trend in recent years of major antitrust cases in this area. One needs to look no further than the recent criminal cases involving, municipal bonds, LIBOR, foreign currency exchange, and ADRs listed out on the screen to show that the antitrust agencies have been very paid close attention to this area and have been pursuing some of the most hardcore cases. In all these cases, there have been massive fines and penalties. There have been criminal convictions. Individuals have gone to jail, and there have been significant follow-on private cases. What we also see in these matters is some enforcement tools that I'm sure will continue to be used as well. For example, in the Muni Bonds case, the division worked quite closely with the U.S. Securities and Exchange Commission in investigating and bringing the actions. And in LIBOR, the division worked hand in hand with both state enforcement agencies in the U.S. and also international enforcers to prosecute the case. In addition, many of these cases deal with benchmarks, types of programs where the industry wants some type of standard to be able to operate more efficiently. In most instances, those types of standards are perfectly fine, but they obviously can cross the line when there is any type of anti-competitive conduct. And I think showing these types of cases here and the government's actions, we can expect the government to continue its focus on these types of areas. In the prior slide, we talked about criminal enforcement, but I think it's also very clear that the administration will follow the Trump administration in aggressive civil enforcement of the antitrust laws in the financial markets. A recent head of the agency gave a speech where he said the division is, quote, leaning in to aggressive enforcement in financial markets. And I think we would expect this to continue. The Antitrust Division has taken several significant recent actions. They, in fact, reorganized themselves to create a dedicated, quote, financial services, fintech, and banking section. This is a grouping of both attorneys and economists who will be specializing in this area. The division went so far as to announce that attorneys and economists in this group will be taking dedicated courses at MIT involving blockchain, machine learning, and artificial intelligence to stay abreast of current developments in this fast-changing area. We also have heard, and I think seen, that the Antitrust Division is going to be cooperating much more closely with the SEC. This is a very important legal development. Many of you may remember the Credit Suisse v. Billings Supreme Court case from about 15 years ago, in which the Supreme Court said that antitrust enforcement could be precluded if conduct covered by the SEC was in conflict with the antitrust enforcement. This is so-called preemption. In that case, the division and the SEC were on opposite sides. I think the government learned from that case, and we have seen in other regulatory areas that the government has tried to, the Antitrust Division has tried to work very closely with its counterparts in other agencies to avoid preemption disputes. There's one famous case dealing with airlines where the Antitrust Division filed a suit against United Airlines involving slots at Newark Airport, and in that case actually got a declaration from an official of the Department of Transportation stating that there was no preemption. So I think we see now that the division wants to use this learning to increase its cooperation with the SEC to avoid any type of conflict in the future. Now, and perhaps most importantly, with regard to civil matters, is we see increased enforcement. And the division is focused on two particular trends, and both of which have been involving fintech in the fintech area. First, there's a focus on acquisitions of startups and emerging technologies. And I want to talk about a specific case on that next. But also there has been a focus on vertical transactions. These basically are deals not involving direct competitors, but entities at different levels of the supply chain. And I think we can expect both the Antitrust Division and the Federal Trade Commission to take a very close look at such cases going forward. Let me talk briefly about one such case. In 2020, the Antitrust Division sued to block Visa's acquisition of Plaid. The allegations were fairly straightforward. According to the Antitrust Division, Visa was a monopolist. It had a 70% share in, quote, online debit market. Plaid is a recent fintech startup, but it powered innovative apps such as Venmo, Acorn, and Betterment. And it, in fact, had plans to offer services that in the future would compete with Visa. Therefore, DOJ said, Visa's acquisition would stamp out a nascent competitive threat. This is what they call the killer acquisition. And what was motivating DOJ here? I think it was a couple things. First, there have been just perennial complaints about the high cost of Visa's debit service. But also, though, we saw a lack of disintermediation in this area that was typically found in tech markets. And this is one area where I think financial services maybe is slightly different than what we think of in terms of the traditional Silicon Valley tech area, and that the division will be taking a close look at how the marketplace circumstances have actually played out. Now, in that case, if you look at the complaint, the division had access to the internal documents for the companies and were able to make, much hay out of some admissions and some statements that executives had about how the two companies could be competing against each other in the future. And that's something that I think we will expect the antitrust agencies to continue to do. So in any type of M&A activity, there will be a close look at both the marketplace circumstances and the executives' beliefs about where the marketplaces are going. Visa, though, abandoned the transaction on the eve of trial, and so we don't have a full record or a court opinion about how the case would have played out. But I think, and also just in my concluding about the U.S., so we see three major topics here. First, aggressive antitrust enforcement in the new administration will continue once, of course, their people are in place. There will be a continued focus on financial services, both civil and criminal cases. And third, I think we expect the division to push aggressive theories, consistent with the progressive views of people like Professor Khan and Tim Wu, and as shown in the Visa Plaid matter. And with that, let me please turn it over to my colleague, Francisco Todorov, to talk about events in Brazil.
Thank you, Bill. My topic today is some information for you regarding competition, innovation, and regulation in the Brazilian financial sector. Just to start a little bit of background in the market, there was a lot of consolidation over the last 30 years or so in the financial industry in Brazil. Currently, 5 banks hold about 80% of deposits and control 80% of credit. That is, of course, a highly concentrated market. As we all know, the financial industry has relevant barriers to entry. There are scale, economy matters. There is cost of following regulatory rules, access to customer information. There's a substantial amount of verticalization in the industry, and in some cases involving exclusivity arrangements. So that's a market that competition authorities typically don't get very excited about. The question is whether innovation and the technology in the industry can bring change to that scenario. Obviously, digitalization has been a major disruptor in many industries, and that's not different in this particular one. So the entry of fintechs is seen by the government in Brazil as a major factor to drive innovation and reduce the cost of products to customers. So digitalization reduces barriers to entry in a way, but it doesn't really address all major barriers that need to be faced or superseded for competition to really take hold. So there are a few issues that are being, and this is the topic of the discussion here, are being addressed both from the competition and regulatory perspectives to facilitate entry. The first is interoperability of the different systems, access to customer information, and how to address the issue of switching costs. Due to a dispute over jurisdiction, the involvement of the Brazilian competition authorities, or CADE as they are known, in the financial sector is relatively new. Because legislation, the way it was written in Brazil, gives or generates questions of whether the central bank has jurisdiction over antitrust in the financial sector or CADE. CADE was effectively silent until about 2011 on any matters regarding financial sector. So 2011 was the first enforcement action against the Brazilian government-owned Banco do Brasil, which used to be the largest bank in Brazil, regarding exclusivity on concession of credit for civil servants. So that was the first time CADE actually stepped in and said, no, I actually can do this and I will intervene. So from 2011 onwards, so about 10 years now, we've seen a lot of action. About 26 cases have been opened involving a variety of different antitrust issues, from traditional cartel cases, those are the Forex cartel cases that we see in other countries as well, to abuse of dominance matters, including issues on exclusivity, discriminatory access, interoperability, refusal to access customer data, etc. 13 of those cases relate to payment methods. And in payment methods, we are talking about interoperability, discriminatory access, and so forth. And in parallel to the activities of the antitrust authorities, we see the regulatory agenda of the Brazilian Central Bank focused primarily on promoting competition and innovation. And this is done through the so-called open banking agenda, which of course is not exclusive to Brazil. We are seeing movement on open banking in Europe, Australia, the UK, and many other jurisdictions, and Brazil is following suit. The clear goal being innovation and competition, and fintechs are really the path or the way that the government sees that this innovation competition can be quickly introduced. It starts with a change of parameter that's key. It's the concept that customer data is not an asset of the bank, it's an asset of the customer. And therefore, it is the customer that can and should have control of how and when the information is shared. So the rollout of the open banking agenda is all happening this year. So the first phase was standardization of the way information is presented so that it can then allow for comparison of different offerings by different banks. In July, we're going to see the ability of customer to allow its data held by the bank to be shared by two other financial institutions. That's going to be, I think, the key element towards the implementation of this agenda. Then we see initiation authorized outside bank apps and web pages happening in August, and then towards the end of the year, the increase of products and services that can have information or data shared, and that's a move from what is being said, open banking towards open finance. The question here is, how do we measure the success of the agenda of the central bank? One way to look at it is whether that's going to reduce the number of cases held or opened or investigated by the competition authorities. If we consider what the goal of the central bank is, more innovation and more competition, and the way they go about addressing those goals, which is eliminating the bottlenecks of access to customer information and interoperability and discriminatory access, if those are successful, we should see a reduction in the future of the number of new investigations initiated by CADE. Of course, we can't know whether that's going to be the case. We do know that many of the cases that currently exist or have already happened revolved around those bottlenecks. So we'll see what happens in the future, and it's going to be interesting to see the impact of the regulation over antitrust enforcement. Another relevant development, and this is very new, this just happened last week, is the entry of WhatsApp Pay into the market. That's probably the first big move of big tech into the financial sector in Brazil. WhatsApp, of course, the messaging app that in Brazil is universal. It is definitely one of the main forms of communication in general, not just personal communication, but business as well. So what the service is the ability that people can transfer money inside the app without actually having to get out and go into the banking app or internet or other more difficult forms of transfer. So this has been allowed. I mean, it's only in its initial stage. It's only individuals to individuals. There are a lot of limitations on how much money can be transferred, etc. But it is the first step. The second step that still needs regulatory approval is transfer from individuals to merchants. So once that happens, that's going to be a major or potentially a major disruptor in the way electronic payments are done today. A lot of business is already being conducted by WhatsApp. But if you add the ability to make those payments through WhatsApp, then there might be other questions about access, who can get access to the WhatsApp forms of payment, etc. So that's something that will be interesting to watch going forward as well. And finally, just as a side note, this is not specific to the financial industry, but it doesn't exclude it. There's a new development in Brazil that is relevant across the board. For the first time, CADE is investigating alleged anti-competitive information exchange by HR professionals through benchmarking exercises. This particular case involves the medical equipment devices industry. But the issue that's being discussed is not uncommon in other industries, and so we might see more cases being brought in the near future. What's interesting on this case is that there is no allegation of an agreement, no price fixing, no discussion about no poaching, no discussion about no solicitation. It is purely information exchange, and according to the authorities, the information exchange would have a potential of leading to uniformization of compensation and benefit practices. The tiered harm here is untested, is a new case, is a living case. It is unclear which types of HR benchmarking would be allowed or would not be allowed under the law. So that's something to watch. And on this particular point, it's a good segue to our next speaker. Christian is going to be addressing the issue of HR and antitrust more broadly. Thank you.
Yeah, thank you very much, Francisco, which now leads over to our discussion about current antitrust topics for the financial service industry in Europe. And I will start with one very important topic which affects the business in Europe, which has already been mentioned by Francisco as a side note at the end. It's a topic which relates to anti-competitive agreements in the labor market, which means infringements of competition law by coordinating any kind of HR-related topic, for example, no-poach agreements, but also other aspects of anti-competitive exchange of information. This is a topic which we have seen in a number of countries, but which relates in particular to the financial service industry, and where we see a lot of action of various competition authorities in Europe, which I quickly wanted to talk about. As you may all be aware, this is an important topic, or has been an important topic already in the US, where we have seen a couple of cases in the past. And the difficulty of this topic is that it is not obvious that such agreements or such exchange of information affects or infringes competition law. So we are really talking about a kind of gray zone issue where many people active in the market are not aware that what they are doing is affecting competition law. And here this is in particular a gray zone, since the persons dealing with these topics are not the typical persons dealing with pricing or any other competitively relevant issues, but this in particular targets the HR departments, which are usually not so familiar with competition law. But on the other hand, regulators say it's very simple, and you see here a Twitter post of Joe Biden, which he said even before he became president, where he made it very clear that this is basically a simple topic, and it's really important that companies are aware that such HR-relevant discussions or agreements may affect competition law, and where he also made it clear that competition authority will investigate this very thoroughly. And as I mentioned, this is one of the hot topics very high on the agenda for competition authorities in Europe, be it the European Commission or national competition authorities, in particular also the German Bundeskartellamt, the jurisdiction where I'm coming from. So as you have seen, we have a rich history of these cases in the United States. It started about 10 years ago with the first big case in the Silicon Valley, where the war on talents, in particular in the software developer area, kind of triggered these kinds of agreements, which were then also investigated by competition authorities. We then had a couple of other cases also, according to the press, relating to the financial industry. Then we had mainly civil cases, and this year there was a first criminal proceeding in the healthcare sector. They are all kind of related to the topic which I just mentioned, which even led the US authorities to issue about 4 years ago a specific guidance from the DOJ and the FTC, which are targeted for HR professionals, where the authorities kind of summarized the status and also the risks in this area. This is something which we in Europe have kind of read with interest, but we didn't have any of these cases, but now we realize that this kind of type of proceedings is really spilling over to Europe, and where we have seen that there are many European competition authorities also trying to pick up this issue and also starting with kind of precedent cases, which are also targeted to show to the industry that competition authority will take it seriously. We had quite a number of cases. A few examples are kind of one of the first leading cases in the Netherlands, where there was an agreement between several hospitals preventing the hospitals from rehiring employees who had terminated their contracts with one of the other hospitals. So that was one of the first cases we have seen in Europe. Then we had an important case in Spain, which even led to the imposure of fines, 14 million euro fines for companies in the road transport, freight forwarding industry, which also colluded on kind of no-poach agreements that prevented the companies from hiring employees from a competitor. And then maybe that's financially the most severest proceeding was a case from the French Competition Authority a few years ago in the area of floor coverings, where the French Competition Authority even fined the companies a record fine of 302 million euros for entering into rather, I would say, gentlemen or kind of gentleman agreements, which had the effect not to kind of solicit employees from the other companies, but which also had a strong information exchange aspect in it. So basically, the companies shared information on salaries, on bonuses, and kind of similar things, and that has been fined by the French Competition Authority, which I think triggered a lot of attention. We also do know that the EU is looking into these kinds of agreements, since companies became aware that this is an issue and also have looked at it from a compliance perspective. And just 2 weeks ago, the Portuguese Competition Authority started a consultation for these kinds of no-poach agreements, which they also combined with a warning to companies not to infringe competition law with these HR-relevant topics. I mentioned at the beginning that it is quite difficult to look at it, since many companies are not aware that this may infringe competition law. But if you look at it from a kind of systematic way, then you see that it is very kind of clear application of competition law. We are basically talking about a coordination of competitively sensitive topics between competitors. We are talking about information exchange of sensitive issues between companies, which basically lead to a restriction of competition, either intended or at least which may have the effect of restriction of competition. So basically we are talking really about principal competition law, where competition law applies, and the only exemption which exists that has also been recently clarified by the European Court of Justice are collective bargaining agreements, which are basically a core part of labor law. But anything else may affect competition law as any other competitive sensitive information like pricing, if that is discussed between competitors. So why are we talking about this topic in particular in this seminar, which focuses on banks and financial institutions? The reason is that we do see a high risk that these issues may affect this particular industry. Why is that? Or why are financial services companies so much in the spotlights? On the one hand, at least in some areas, the wakes are quite high. Then there might also be a bit comparable to what we have seen in the Silicon Valley 10 years ago, a war for talents, in particular in the investment banking area. And I think that we have seen in these proceedings in Europe, there's a high grade of transparency in the market because there are many informal meetings where competitors meet, where also HR professionals meet, and where they are in a position also to discuss these kinds of topics we are talking about. So we in particular, or if you look at it, we in particular see quite a number of forms of problematic conduct. This is on the one hand, I think that's quite obvious, the no-poach agreement, but also kind of coordination of wage fixing agreements. But these discussions can also lead to alignment of other terms which are HR relevant, like benefits or the allowance for cars or any other additional agreement. So basically an information exchange of any of the competitively important aspects in this financial services industry. However, we are often asked by our financial services clients whether this is really a high risk. Of course it is, but it's not too much to worry about because there are, of course, many areas of permissible conduct. This is on the one hand the benchmarking. Francisco mentioned that a little bit at the beginning. So, of course, benchmarking is permitted if it is aggregated, the information, if the information is anonymized, and obviously also if it in particular relates to historic data. So there are many ways of safeguards to prevent an infringement of competition. Then there are a couple of restrictions in employee contracts which are also permissible, like non-compete clauses, which are at least possible up to 2 years, even with a certain compensation. Then also contractual restrictions on team moves should be permissible. And also we often see non-solicitation clauses to prevent former employees to solicit others, which may also comply with competition law. Nevertheless, it's really important to do a case-by-case analysis, and then you can also make sure that in this gray area, which the authorities think it is easy, but where, and this you may have seen in my presentation, companies tend to find difficult, where you can deal with that without having a too high risk of infringing competition law. Thank you very much. That was my part. And now I hand over to my colleague Natalie from Paris, and she will focus on another important hot topic in European competition law.
Thank you, Christian. Now, if we consider the approach of European competition authorities to fintech, we see globally the same interests and concerns as discussed by Bill and Francisco earlier in this presentation, which we will illustrate with the most recent initiatives and case developments. Over the past years, the European competition authorities have invested time and effort in order to better understand fintech markets and the difficulties fintechs face to develop. As early as 2018, several competition authorities have looked into more details at the way fintechs operate and need access to infrastructure, data, and clients to operate. These reports have stressed the specific characteristics of the markets concerned and the main potential restrictions. The Dutch and Spanish reports were clearly adopted in that spirit and looked in particular at how the fintech markets work and the various levels of access issues they may face. The objective is first to assist regulators and legislators to address the sector so that fintech can deliver benefits to the consumers. And second, it's also a way for competition authorities to prepare to handle cases in a highly regulated and specific business sector. The most recent reports consider that access issues identified from the earlier studies largely remain applicable And you can see on the slide the test carried out by the Portuguese authority very recently, showing that a number of barriers to entry still exist for fintech companies. Aside from the Portuguese one, which was released very recently, the French fintech sector investigation report was just published a few days ago after a wide sector investigation into the sector. Aside from entry barriers, which are also addressed in the French report, new subjects have been included in the picture, such as algorithmic collusion, which is a subject high on the agenda at the global level and may concern fintech, just as any other digital market, and several significant developments are dedicated to this issue in the French sector report. The two most recent ones also focus very much on the arrival of big techs on fintech markets, and already provide a number of views on specific dangers associated in the view of competition authorities to the arrival of big techs, either by fresh entry or by acquisitions. The European Commission itself has launched an overall initiative which is of direct relevance to the fintech sector. Under the proposed Digital Markets Act, core platform services qualifying as gatekeepers would be imposed new obligations. The new provisions could be adopted in the course of 2022, and non-compliance with a number of positive and negative obligations listed in the proposed regulation could lead to the imposition of fines, and this could take place in a very limited time frame compared to a standard antitrust procedure. Getting prepared for action also concerns the merger review front. In continental Europe, tools have been improved to ensure that the acquisition of fintech companies can be caught for review, even where these fintechs still do have a limited turnover, not reaching the standard merger thresholds applicable either at the national or at the European level. The first initiative to have been adopted concerns Germany and Australia. These two member states have adopted additional thresholds for mandatory notification, and these thresholds are expressed only in value of the transaction, and therefore can catch acquisitions in tech sectors globally, including in the fintech sector. More recently, the European Commission has also decided to clarify that it would accept referrals of merger cases by national competition authorities when the EU thresholds are not met. These referrals have existed for long. Now it is also clear that these mechanisms laid down in Article 22 of the regulation can also apply in a case where national thresholds are not met, as long as a transaction is likely to affect competition within one, and concerning fintechs, several member states. If we haven't seen many significant developments in the merger field so far in continental Europe, it is very different in the antitrust field, with several ongoing or closed actions, in particular against Apple Pay. The formal investigation opened by DG Comp in 2020 is certainly the first large-scale infringement action in Europe on that front. And the Commission has in particular announced that it had gathered elements relating to the terms for the integration of Apple Pay on merchants' apps and websites, and second, access of other mobile payment solutions to the NFC technology, which is embedded on iOS devices. DG Comp is now preparing a statement of objections potentially on these two aspects. The access concern for other mobile payment solutions is shared by a number of other national competition authorities. The French report I mentioned earlier on contains a number of developments as well concerning mobile payment systems, including the comparative table, which is reproduced on the slide. But I would like to mention in particular the action by the Swiss Comco in late 2018. So it was one of the early cases in that frame. And this initiative is interesting to note because Apple, in that case, rapidly agreed to implement commitments, including a technical solution to enable rival payment applications on its mobile phones. The complaint had initially been lodged by Twint, a competing mobile payment system created in cooperation by a number of Swiss banks, so that the case was rapidly closed. However, since then, Comco opened an investigation for potential boycott against the same Swiss banks which created the Twint system. They are suspected of having agreed not to enable the use of their credit cards for use with Apple and Samsung phones, and possibly that behavior has been adopted in the backdrop of the complaint initiated by Twint. The investigation on that part of the case is still ongoing. We will have to see what comes out of these cases. The particular broad approach of EU competition authorities in the latest cases in the tech sector, and not only the fintech sector, in particular a broad concept of abuse of dominance. These particularly broad approach starts to be clear at their level, and we will see how the courts themselves consider these new approaches of competition authorities and the heavy duty it places on gatekeepers to deal with competitors in particular and users generally speaking. To conclude, I would like to stress two potential developments for the coming months in the fintech sector that may be found in the French fintech report. First, the French competition authority stated in that report that it was open to arguments to review market definitions into this sector in the light of the most recent market developments and fintech's ability to compete directly with a number of traditional banking services. According to the report, fintechs cannot yet be considered sufficiently established on the markets to avoid having to trade with national banks, but the authority recognized that it might be time, at least on some markets or some segments, to include fintechs as direct competitors to traditional banking players. Interestingly, too, the authority noted that traditional banking players face risks in the coming months and years with the significant volumes of business lost to fintechs on the other hand. In particular, in relation to some universal banking services involving high fixed costs that traditional banks would not be able anymore to compensate considering these lower volumes. Under these two potential evolutions, we could see case developments include considerations that are very significantly changing the approach of our competition authorities, and not only the French one, be it in merger cases or in potential infringement cases. I remember Francisco mentioning the mature markets in Brazil, this on traditional banking, and this could very well characterize a number of our banking markets in Europe. As long as fintechs are included into the picture, once again, at least on some markets, these could change the approach to potential mergers and cooperation agreements, either with traditional banking players or between them. At this point, I hand it over to David to develop the post-Brexit enforcement context in the UK.
Thank you, Natalie. Since the 1st of January this year, the Competition and Markets Authority, or CMA, and sector regulators, including the Financial Conduct Authority, now have sole responsibility for applying the competition rules in the United Kingdom. As a result of the UK's departure from the European Union, the CMA is already handling larger and more complex cases. It anticipates about 50 additional merger investigations per year and more parallel investigations involving different jurisdictions. The CMA has also recently predicted an increase in cases in the financial sector. At present, the UK's rules on anti-competitive conduct closely reflect EU law, but there's likely to be some divergence over time. And an early example may be the emergence of a distinct competition regime for the tech sector. More generally, the CMA has already entered into a cooperation agreement with several other jurisdictions, and an agreement with the EU is planned. Looking to the future, various reforms of competition law are currently being discussed, including a recent report by John Penrose MP, which focuses in particular on consumer protection and the digital economy. And the former chair of the CMA also made proposals which, if implemented, would entail the imposition of more onerous obligations on boards and individuals. Pending regulatory changes in related areas include the new National Security and Investment Act and the new UK subsidy regime, which I'll touch upon briefly. Turning first to enforcement, the CMA is now viewed as one of the most interventionist competition authorities worldwide. It's gained additional resources in response to Brexit. It's taken an expansive approach to jurisdiction in a number of international cases, and over the last year or so, a high proportion of mergers referred for Phase 2 investigation have been blocked or abandoned. Of course, it's difficult to generalize about enforcement trends, but it remains the case that the voluntary nature of the notification regime in the UK can give rise to a false sense of comfort in merging parties. In March, the CMA published updated merger assessment guidelines. These focused in particular on providing guidance in relation to transactions in the technology sector, in particular to address a perceived risk of under-enforcement. And consistent with this, in a joint statement issued in April, the CMA highlighted the need for rigorous merger enforcement. The statement has an element of back to basics and cautions against over-reliance on advocacy by the parties, while stressing again the importance to the CMA's assessment of internal documents. The current priority of the CMA is consumers, both in general as well as vulnerable consumers who may need greater protection in the context of the pandemic. And finally, in relation to behavioral investigations, another notable aspect that we're observing is the increasingly sophisticated use by the CMA of technology, for example, in dawn raids. Like the other competition authorities that we've heard about, the CMA is grappling with the challenges presented by digital markets and powerful technology companies. and we see many similarities in the UK's response. A new digital markets unit started operating in shadow form in April, pending the adoption of relevant legislation. And the CMA has recommended the creation of a new ex-ante regulatory regime governing conduct of key aspects of firms with so-called strategic market status. This will apply where a company has substantial entrenched market power in at least one digital activity and where this confers on the company a strategic position. The new regime will have three main elements. First, enhanced merger control rules involving mandatory notification and suspension, as well as, in echoes of what we heard from Bill a moment ago, a lower standard of proof for the CMA in Phase 2. Second, a legally binding code of conduct, and third, pro-competitive interventions. The CMA has recently stated that the DMU is already exploring an active pipeline of cases and has indicated that it intends to increase investigations and enforcement in the technology sector with or without the proposed new formal legislative powers. The CMA anticipates, quotes, new territory for competition policy, quotes, with significant powers to promote the consumer benefit. And it's also reasonable to assume from this that it will give rise to increased litigation. The Financial Conduct Authority is expected to have a role in the Digital Markets Unit, and more generally, there is an acknowledgement of the need for greater coordination between regulators in this area. Accordingly, the CMA, the FCA, Ofcom, and the Information Commissioner's Office have recently established a Digital Regulation Cooperation Forum. An initial aim of this relates to understanding the role of algorithmic processing, including in connection with financial services, building on initial work by the CMA. And there's also a broader debate about the social impact of fintech, which, along with ESG and other policy considerations, may influence the legislative approach and enforcement policy. Looking beyond the UK, as we've seen, in addition to addressing the interaction between these new regimes for the digital sector and the normal competition regimes, companies will need to get to grips with similar but distinct regimes in other jurisdictions, for example, the EU and Germany. Turning more specifically to fintech, the application of competition law presents its own challenges and opportunities, as we've heard. These include, first, how to regulate financial services businesses that are employing previously unknown technology. Second, how to regulate big tech firms that are competing with regulated businesses. For example, the CMA has commented that large platforms may have an advantage when entering or expanding into financial services. And third, defining the so-called regulatory perimeter of the FCA when new technologies and business models and products are continually emerging. There are already signs of possible regulatory competition in echoes of the age-old national champions debate. The Khalifa review of UK fintech, published in February, recommended more flexibility by the CMA in the assessment of mergers in fast-growing markets in order to facilitate the growth of UK fintechs into global champions. In March, the CMA launched a consultation on how to strengthen open banking and ensure sufficient competition. The CMA commented that while the largest banks have shown signs of embracing open banking, they may also have an incentive to slow the further development of the open banking ecosystem where this conflicts with their own commercial objectives. The FCA is currently exploring the potential of open finance, which would extend open banking principles to other types of financial data. In relation to enforcement, the cases have tended to be fact-specific, and it remains early days. A recent example is a proposed merger between two crowdfunding platforms, Crowdcube and Seedrs, that was abandoned following the publication in March of the CMA's provisional findings. Those findings indicated that the merger would have led to a combined share of 90% and that the CMA was planning to block it. Along with issues concerning exclusionary and exploitative conduct in the context of market dominance, collaboration and sharing will no doubt be a particular focus of enforcement. The focus of algorithms has been much discussed, and AI and in due course even quantum computing, as banks increasingly deploy them, will no doubt give rise to specific challenges. In relation to competition enforcement in the financial sector more generally, the FCA has had concurrent competition powers since 2015. There are, in fact, few published competition decisions of the FCA to date, but a statement late last year indicated that it's looking to open more competition cases. A significant example of enforcement action by the FCA is a finding of collusive conduct by asset managers concerning the sharing of price information in the context of IPOs. The UK is unusual in having a separate payment systems regulator, which was established also in 2015. In an early investigation, the PSR issued a statement of objections in March this year in relation to a suspected cartel in the prepaid cards market. And the regulatory regime governing payment services contains provisions very familiar from the utility sector, for example, concerning access, and this may provide fertile ground for challenges by market entrants. Finally, private enforcement in the financial sector is also increasingly important in the UK. In the Merrick's case, the Supreme Court rejected the finding of the Competition Appeal Tribunal that quantification of losses of consumers in a collective action relating to interchange fees was too difficult. This will no doubt give rise to additional collective actions. And foreign exchange is another area in which there is active competition litigation. Finally, two pending regulatory changes that I announced, that I mentioned briefly at the outset. First, the National Security and Investment Act. Following the grant of the Royal Assent on the 29th of April, the Act will now enter into force later this year. It provides for mandatory notification and prior approval of certain acquisitions of control of entities in specified sensitive sectors. Notifications will be made to the Department for Business, Energy and Industrial Strategy, or BEIS. In a significant change from the bill, the government has raised the lowest threshold for notification from 15% to 25%. In addition to the mandatory notification provisions, there is a 5-year retrospective review power for other acquisitions of control, including certain acquisitions of assets. And that power is already potentially relevant to pending transactions. The Act will be applicable to various transaction types falling outside standard M&A. For example, we've been considering its impact on security enforcement and restructuring. Secondly, the Trade and Cooperation Agreement between the UK and the EU provides for a new UK subsidy regime. The government is currently developing the details of the new arrangements, but broadly, like the EU state aid rules, they will apply to a wide range of forms of support, for example, state guarantees. The regime will be based on ex post rather than prior approval, or ex post challenge, rather than prior approval. Subject to the detail of the new regime, this may have consequences for legal certainty, for example, in relation to major projects. Finally, in a related and significant development last week, the EU published a draft regulation on foreign subsidies. So in conclusion, this rapidly changing landscape will continue to require vigilance. As ever, early transaction planning and a focus on effective risk-based compliance procedures will be key. This concludes today's webinar. We hope the information shared today was useful. Thank you so much for your participation and have a great day.